The honor. Okay, welcome everybody to the short-term rental tax planning webinar. I am your host, Sam Boyd, president and founder of Comfortable Advice Investments. And I am joined by some of my esteemed colleagues for this topic, which we couldn't have pulled together a better group. First, I'll introduce Richard Goolsby, who many of our clients know is a senior tax manager for Mariner Tax. Richard, thank you for joining us. We also have Steve Ruda with us, who's the Director of Specialty Tax Services at Mariner, and the man behind the cost segs. So the one who's actually doing the work for our cost segregation study. So thank you, Steve. And then last but certainly not least, we've got with us Matt Sislin, who's a Confident Associate Advisor, and also a 2-decade plus veteran real estate developer who brings with him a wealth of knowledge around real estate investing. So thank you, Matt, as well for joining us. Right. So with that, we can jump in. Some disclosure slides to keep the compliance folks happy. And then a little bit of housekeeping. You guys should be able to use the Q&A feature through Zoom if you have questions. So shoot those in. I'll try to get to them sort of as we're going. Any that I don't get to, I'll hold for the end. So we make sure we answer all the questions. But please feel free to send them along as they come up. And then into agenda, right? So we'll talk about why this matters, why even have a webinar on it, and why it's impactful and worth talking about. We'll get into depreciation, cost segregation studies, the sort of one of the key ingredients, which is material participation, and documenting it from a tax perspective, and how to make sure that you will be able to use the benefit of depreciation on your return. We'll talk about some other tax strategies you can consider pairing those up with financial planning and tax strategies. And then we'll get into a little bit of an overview on owning the properties, managing the properties, risk management. And then finally, we're going to work through an actual model, an underwriting model that includes the benefit of the tax deduction plus the sort of key variables that we look at to see if a deal pencils out, right, and has the type of return that you would want as compared to other asset classes. So with that, let's do a little bit of background. So short-term rental investment, bonus depreciation, cost segregation, what are all these things? This all started from the Tax Cuts and Jobs Act in 2017, and that's when the concept of bonus depreciation was introduced sort of through the lens of short-term rental real estate. This was then revised. I was set to sunset this year, but it was revised in the One Big Beautiful Bill Act. The recent tax legislation brought back bonus depreciation. And so unpacking this a little bit, short-term rental, right? What is this? This is an Airbnb or a VRBO, right? Something that you're renting for, a handful of nights. You'll see 7 nights or less becomes a very important threshold. Depreciation we'll talk more about, but every asset that you put into service for business use has a depreciable life in the eyes of the IRS. And if that is short-lived asset, which we'll talk more about, that means that you can deduct it all at once, right? That's why we call it bonus depreciation. And then the cost segregation study, where does that come from? Well, this is how we get the ability to do what's called component depreciation, right? You have to segregate all the parts of the house, right? So that you can identify what lifespan it's really on. And then, once you've done that exercise, you can then pursue bonus depreciation. So this all comes back to the tax code and then ultimately tax strategy. I'll say a couple of things though, just, this is not passive income. A lot of people will see online or, stuff on Instagram that says, hey, check out this very, passive way to earn income and get tax deductions. Running a short-term rental or even a long-term rental, I mean, it's not for everybody. There's work involved here. Like, it takes time. And so if you want passive income, your dividend-paying stocks, right, are a much more efficient way of getting passive income. This is very much a commitment of time, a commitment of resources, and you are in a customer service business. You're in a real estate investment, but it's a customer service business, right? And so it's not for everybody. I'd also say that you wouldn't want to purchase real estate, simply for some tax benefits, right? Like if we can make this part of your broader set of goals, or if this is part of your broader set of goals to own, real estate in a different location or a different state, or to, convert something into a primary down the road, right? This can become part of a tapestry of strategies and solutions that can help you reach your goals. But again, it's not for everybody. If you've got to have the bandwidth and the time and, you want to devote to it. So with that said, the short-term rental combined with bonus depreciation and cost segregation studies has been one of the most powerful tax planning opportunities that we've been able to use for our clients in the past couple of years. And now that it's back at 100% depreciation this year, we're bringing this webinar to you. And so, we've got these sort of three pillars, right? The three pillars of using rental real estate in your portfolio. The first is tax deferral. So we talked about accelerated depreciation, right? We can take large on paper losses, depreciation losses, where they would normally not be able to be used against your other income, right? But if we meet certain criteria, they can be used to offset your other taxable income. We say tax deferral because you get the benefit of the tax deduction now, but it's then, if it's then carried forward, right? Like if you ultimately sell the property, you're going to recapture that depreciation. Now, there are ways to manage that. We've got 1031 exchanges, Delaware statutory trust. You can pass away and have your beneficiaries inherit an asset. We'll talk more about that, but it is, by nature tax deferral, right? The other piece is cash flow, right? So short-term rentals typically will outperform long-term rentals in terms of their cap rates, cash on cash returns, and bottom line, the amount of income that you can earn on them, sort of by their nature. And so they're an attractive asset class, for that reason, if you're interested in real estate. And then the last piece is appreciation, right? I mean, you're owning a piece of real estate, right? Ideally, you're using some leverage on it. And it should be fairly uncorrelated in terms of an asset class to the rest of your portfolio. So there's this, wonderful sort of math that occurs when someone else is paying down the mortgage, right? And your home is also appreciating, and you're pulling both of those levers at the same time every year, and that value just kind of widens out and widens out over time. So I think a lot of advisors like myself probably wouldn't go down the rabbit hole of short-term rentals because they can't bill an AUM fee on somebody's real estate portfolio. But if it's part of your broader framework, you've got the bandwidth, you're interested in doing this, it can be a really, really, really powerful tool inside of your portfolio. And so with that, I want to jump into understanding a little bit more about depreciation. And Steve, feel free to chime in on this part, or anybody else, of course. But depreciation at its core is, like I mentioned before, everything you place in service inside of a business has a depreciable life. And you're able to take a loss on paper that represents the decline of value of that piece of machinery or equipment, or in this sort of situation, component of the home. And so when you take that loss, right, that loss will reduce the income that you receive from the rental activity. And then ideally, if we structure correctly and meet the right criteria, we can then take that loss, right, and pass it through, onto your personal return against your W-2 wages, 1099 income, dividend income, capital gains, et cetera. And so, Steve, anything you'd add to that in terms of, thinking about depreciation?
Yeah, the depreciation again is they want to look at things that are a long life. So anything useful life of over a year. And so when you buy inventory or you buy supplies, you're going to expense those right away. It's the items. It can be a car, it can be furniture, it can be any of those things that have a longer life than 1 year, a useful life. And so that's what we look at, a capitalized or property versus and what we have to depreciate versus again as a supply or a repair expense.
Right. Those are, you just expense those right off in the year that they occur.
Correct.
But you hit on something a moment ago. When we're looking at the sort of aggregate depreciation we can take and the tax benefit on a property, it's not just the cost segregation study, right, and breaking apart the components of the home and depreciating them, all at once for the short-lived assets. It's also furniture, fixtures, and equipment, right? And so, typically, if you're getting a short-term rental, it's an empty home in many cases if it's not a turnkey property. When you go to furnish it and put all the, couches and the beds and, all the stuff that goes into it, right? That, by and large, those are also eligible for bonus depreciation in the year that they're placed in service.
That is correct.
Right. And so, this is where I'll just, sort of give this example. If your normal rental real estate is a per se passive activity, meaning that if you've got a whole bunch of depreciation that creates a loss on the real estate activity, you don't actually get to use it in that year. It's considered passive and it carries forward. The whole key to this is getting, active participation, active and material participation, which means that you can unlock those losses and use them to offset your other income, W-2 wages, Roth conversions, 1099 income, capital gains, et cetera. And so I want to jump into material participation through the lens of short-term rental real estate. So Richard, can you talk to us a little bit about the background on active and material and the requirements uh, for getting this special treatment for short-term rentals?
Sure. Yeah, so what we're after here, especially when we're talking about a cost segregation study, on a normal year, if you do well in your property, you might actually have positive net income. When we bring Steve's team, into the equation, what we're looking at is, hey, we're going to have a year where we've got all this accelerated depreciation going back to bonus depreciation being 100%. That's what we're getting at is we're trying to put these assets into their different class lives of 5 year, 10 year, 7 year, 15 year, 20, up to 20 year. And we can use what's called bonus depreciation on that to accelerate that and take that all in 1 year. So the idea is, as Sam was mentioning, is this can be used to offset ordinary income. Ordinary income includes your wages. Um, and depending on the K1, might include K1 income if it's active income for you. So what we want to do is we want to be able to actually use that loss. Now, on a property, on a short-term rental, what we have to do is we have to meet material participation, and Sam's got it written down here. There's several rules that we can look at, but the two that we generally lean on are the 100-hour test, which means that you materially participated for 100 hours or more, and more than any other individual. And that wording, although that's the exact wording that is given for material participation, individual can be confusing because if you have a property management company, and let's say there's 3 or 4 people that are going in and managing that property for you, that counts as one individual. So you would have to, if you had, 100 hours, but there was 5 people and they all had 40 hours on the management company, you don't just get to weigh it against one of them. They all count to be one individual. And so that would then bump you up into the next test. If you can't meet the 100-hour test, you go to the 500-hour test, which is you participated in the property 500 hours or more. Now from there, we have to go, well, okay, what is material participation? How do I get one material participation hour? And so I've written down some general examples of what counts towards material participation. So communicating with guests, managing bookings, writing reviews, updating your digital listing, um, personally cleaning the unit, of course, washing linens, staging counts towards material participation, landscaping, maintenance, also hiring, scheduling, coordinating, paying cleaners or contractors, and then things like driving to the store to restock toiletries. All of that counts. Now, what doesn't count is driving to the property and back. That's separate. There's a mileage deduction that we won't get into now, but that does not count as an hour in the car driving to the property is not a material participation hour. Okay, so that doesn't count. You can't double up. So if your spouse, let's just say you're somebody who's married, if you and your spouse are both cleaning the house for 1 hour, that's one material participation hour. It's not one for you, one for the spouse. Um, and outside of that, generally looking at financials is not considered to be a material participation hour. Um, there's some exceptions to that, but for the most part, I would not log that as a material participation hour. So what's important is once we know, now we know some examples of what material participation is, logging it is the next step, the very important step because If you get audited, that's what they will ask you for, is they will say, hey, can you show me that you met material participation for this property that allowed you to offset this ordinary income? Now, if I'm your CPA, I'll be asking you about this anyway. When I'm asking about the property, I'll say, did you make material participation? Here's the rules. Um, but I will not, and most CPAs will not ask for that documentation. We don't need it. We just need to know verbally, yes, I did do that. And if you get audited, you're going to have to hand over that time log to the auditor. And so you just want to make sure it's much easier to do that contemporaneous than go back and try and remember what you were doing.
Absolutely. Yeah, we tell people to keep, a Google Calendar is an easy way to do it, to just, document what was done on what day and be able to, produce that down the road. I mean, you want to be as detailed as possible. Um, and again, like contemporaneous, not after the fact. It's very difficult to pull this stuff together after the fact. Um, Richard, thinking more about like hours that count, what about like the process of acquiring the property or what, or any of those activities, would those count towards material participation?
Generally, no, because you can shop around for properties and you might not end up closing on one. You'd have a stronger argument for if you could document the exact hours. Hey, I did buy this property. And though I looked at, let's say I was looking at five. Okay, well, I didn't end up closing on these five, but I can narrow my hours down for just this one property that I did end up buying. That would count. But generally, it's sort of a weaker argument. We generally lean towards, those actual management hours are going to be better proof of documentation for the IRS. Now, I did want to quickly mention so to get what you might do is you might go down to the property to stay and you might stay the weekend and say, "Hey, I need to work on the house for, Saturday, Sunday. I'm going to be working on the property. I'm going to stay the night there." So you want to make sure that you're actually documenting that and what you do to make sure that it doesn't fall under a personal use day. And if you do, for example, have a personal use day, you're just going to go with family or friends and stay at the property. You just want to make sure that you are keeping that to under either 14 days total or 10% of the time that the property was rented out. And you get to take the greater of those two. Okay, so if you are going to go and stay the night at the property, um, and you do plan on making improvements, just make sure to make over half your day a day where you're working on the house and improving it, and you're documenting that.
Yeah, that's the reverse Augusta rule, right? Where
Yes. Yep.
if yeah, you can basically can you speak to that, Richard? Like what that would look like, the situation where that would come up?
The Augusta rule.
Yeah,
Yeah,
the reverse Augusta rule in this case.
oh, where you're limited because you didn't participate. Yeah. So generally, the Augusta rule is something good for people that have a property that they're not planning on doing something like a cost segregation study on. So, hey, it came about from Augusta having the big golf tournament, and the residents there were saying, "Hey, we rent our houses out because of this big golf tournament every year, but it's under 14 days and we don't want to pay tax on it." So they came out with, I'm sure there was some lobbying involved here, but they came out with a rule that said, okay, if you rent your property for under 14 days, we're not going to make you claim it on income tax. It's something that you don't even have to list it on your tax return. But the reverse of that is if I'm working with Steve and I want to take a cost segregation study to allow a loss after I meet my material participation rules, I need to rent it for more than 14 days. Because what happens if I don't rent it for more than 14 days is I've accidentally fallen into the Augusta rules, which is not good for me because I'm trying to use this loss to offset income. So it is something you have to, when you're buying a property at the end of the year, you have to sort of look at that. Now, I have done a little bit of research on the side, and there are some suggestions that the IRS might be willing to hear an argument of, especially if you've got facts and circumstances. So let's say I own 10 short-term rental properties. We know this is what I do. Okay, I just happened to buy this one at the end of the year. Facts and circumstances say no, this wasn't a one-off. I'm not going to get hit with Augusta rules. I am somebody who does this as a business and you can get out of it. But in general, you want to avoid that. So make sure you're renting more than 14 days if you're buying a property towards the end of the year.
Richard? And is it renting or is it available to rent?
So it's available to rent is when we are actually allowed to take depreciation. Renting is does it hit the Augusta rules or not?
Yep.
So if I've rented for 14 days or less, I'm under Augusta rules. If it's available for rent, now I can put it into depreciation, even though I might not have rented it. So
And there's also the personal use part that comes in there too, right? Where you would have to, like, let's say it was under 14 days, but you have under 10% of those days as personal use. Like all of those were business use days, right? That would be another way
yes,
to sort of, avoid getting it pulled in, right?
that's right.
That only shows up when there's a personal use, component associated with it that's greater than 10% of the days that it was listed.
That's right.
Okay, cool. Right on.
Absolutely. Mhm.
So, for most of our clients, we're going for 100 hours, average stay of 7 days or less, and nobody or no business did more work than you in that year, right? Not every year, forever, but in that year, the year in question, right? That's what matters.
Yep.
So we'll talk more about this a little bit more as we kind of move through the presentation. But let's assume so you meet all of that criteria, right? And now you want to do the cost segregation study. Steve, if you don't mind, tell us more about a cost segregation study, what all it entails.
Yep.
And then also, like, as you're, looking at properties, you know, what are some of the things that you would look at to say, hey, this looks like it's, a good opportunity for bonus depreciation versus no, maybe this wouldn't be a good candidate.
Yep. Sounds great. And so a cost segregation is an engineered approach to look at a building. And so what we do is we will break out the components, which it can be especially electrical, can be the washer and dryer hookups, the water lines that go to the washer and dryer. It can be your flooring. It can be, let's say we're in Florida and we have all, the pools outside with the screened in fence that are attached to the ground and not to the house. And so we break out all of those items into shorter lives. And so we have engineers that come in and will break out those items into what is either a 5-year asset or a 15-year asset. A 15-year asset is generally going to be land improvement, so it's going to be exterior of the house. The 5-year property is going to be, again, is the stuff we can break out, your cabinetry, your countertops, your your appliances, the flooring, as long as that flooring is not tile or hardwood floors. And so we do look at that. And so those are things that when Sam asked about what to look for is what type of flooring is there? Is it hardwood floor or is it LVT? That makes a big difference when we're looking at a cost segregation study. Um, but and again is, hey, do we have a pool? What kind of landscaping do we have? Those can make a big difference. Does it have a fence? Those can make big differences in there. And so again, in cost segregation, we will come in and break everything out. Mostly on residential properties, we're finding somewhere between, I'm going to say 17 to 28%. Sometimes we can get over that 28% if we have a large pool or large exterior, I have one that was in Lake Havasu that's, the whole backyard is concrete and it goes from pool to fire pit to barbecue pit to, I mean, it is amazing. And so that can be a higher, reclass because again, that's all going to be your land improvements. And so when we look at those, that's our process and or that's what we're looking for. But our process is working with Sam and Matt. They'll come over and say, "Hey, we have this client that's looking at a short STVR. Send me the address." We also look at a lot at counties, the county land, and trying to find a property that not all of it goes right to land, unless we can get appraisal to come down on that land. But there are some counties, California, Alexandria, West Virginia, or Virginia, their land values are very high. And just kind of seems like those are, some of those. Florida can be really hit or miss. There are some counties that are very economical and very Orange County, for example, which is in Orlando, very low land values. You get into some other parts of Florida and your land values can reach up to 50, 60%. And so we look at the land values and we look at those, and what we'll do is we do that benefit estimate to say, hey, we think we're going to reclass between X and X, and here's what, our fee will be. As Sam says in his slide here, most short-term vacation rentals are going to be in that 4 to 5. If it's a really big project, we did one in St. George, Utah this last year. It was a $16 million short-term vacation rental. That fee was a little higher than that normal, but most of them are in that $4,000 to $5,000 range. And so uh we'll come in, look at those. The other thing with bonus depreciation, one thing I want to talk about today and look at that is again is with the OBBA bill, it does say purchased and placed in service, not just placed in service. So I've had quite a few people say, hey, we're converting our personal property into a short-term vacation rental to take advantage of the new bonus rules. Well, when did you buy the property? If it's before January 20th of 2025, we actually fall back into the old rules, which sometimes if it was bought in 2015, we would actually have 0% bonus because there was no bonus on purchased properties back in 2015. It had to be new construction. Or if it's from somewhere between 2017 to 22, then you're back to the old tax job cap act, which then we would go for 25, it would have been 40%. For 26, it's 20%. And then for 27, it's 0%. And so you want to be careful of that. I know we alluded to podcasts, alluded to the misinformation that you sometimes hear on TikTok and everywhere else. That's one thing nobody's really talking about because I know this has been a hot topic for that. And so just to be aware of that is, hey, it does matter when you bought it, not just when you place it in service.
That's awesome, Steve. And so, a couple of takeaways, right? We the actual property itself, right? We're looking for like high quality finishes, right? That are, short life depreciation. That's going to help. Like you said, LVP versus hardwood floors or tile, for instance. But if there's like significant, landscaping or hardscaping or fences or pools, like that's always like a sort of, green light that this is probably going to end up with a good percent.
Yep.
I have a question from the audience. What's a typical percent that you would expect for an apartment versus
Apartments,
a standalone house?
yep, apartments all vary. And again, it goes into apartments can be higher, but it depends on what do you have for off-street parking. Um, I'm going to be, Sam presented a potential client to us last year, and we looked, there is no off-street parking. So there's no parking lot. It is all on-street, street parking. It was hardwood floors. It was also economy studio apartments, and so literally each apartment had 4 feet of countertop and 4 feet of uh countertop and cabinets, and that was about it. And obviously that's not going to be a good one, but a lot of apartments you're looking really at, we're going to say probably 25 to 30%. But again, it all goes into, does it have carpet throughout, or are they hardwood floors? What do we have for outside? Do we have a pool? Do we have off-street parking? With the newer ones, the amenities that are coming in and what are going into these apartments, there are a lot. It's a higher reclass. It's not just a here's a place to stay. They're putting in a lot more amenities, which increases our deductions and our reclass, if that makes sense.
We can allocate a portion of the purchase price to those 15-year sort
Yep.
of hardscape, type amenities that
Yep.
otherwise you wouldn't be able to.
Correct.
Yeah, so slightly higher. So like just a little math example, Steve alluded to this earlier. Land is not depreciable, right? So, your land to structure ratio, aside from the actual property itself and like, fixtures and hardscaping and whatnot, we're looking for low cost of land, high value of structure, right? And we can get this information from the county records to say how they sort of see it as an indicative. back the napkin desktop due diligence approach. Um, but let's do an example of, let's say it's, $1 million property, 50% land, 50% structure. So $500,000 structure. If we're at a 30% depreciation level, right, that's $150,000 of depreciation that you'd expect, right? Which again,
Yep.
if we meet that average stay of 7 days or less, nobody did
Well,
more work than you, right? 100 hours in that year, that 150, not including the furnitures, fixtures, and equipment that you might need to buy to get it up and running. That's all now unlocked to offset 150,000 of W-2 wages or some, essentially larger number of capital gains because of the, sort of delta in those tax rates, right?
correct.
Um, but that's really helpful, Steve, in terms of identifying. Any other
Yep.
thoughts on sort of like picking?
Yep. The other thing I'm just going to talk real briefly on is so we talk about the whole 7 day. The other thing we want to talk about for apartments, those are normally 27.5 year property because the average stay is more than 30 days. So we have a couple different rules here that we want to make sure. And so if the average stay is greater than 30 days, then it's an apartment and it's that. If it's less than 30 days, then we're into the transient rules and that's more like a hotel. It can be more of that. And so then that depreciation is actually 39 years, but we can take qualified improvement property on 39-year property. We cannot take it on 27.5 year property. So interior renovations, items like we're doing for that, we can take those deductions. The other thing I've seen a lot this year, it seems like, is someone buying a duplex and they want to take half of it as a short-term vacation rental and the other half as a long-term vacation rent or a long-term vacation. And they say, what do you do? Well, the IRS says that's one building. And so then we have to do an income test to see where is that the more of the income coming. If 80% of the income is coming from short-term or long-term rentals, 80%, then it becomes a 27.5 year. If 20% or less is there, then it becomes so if we're getting more than 20% of our income from a short-term vacation rental, then it becomes all 39-year property. But again, as you do renovations, you can take that as qualified improvement property.
Can you talk a little bit more about the distinction between 27 and a half and 39 and why it matters?
Yes, and again, the 27.5 year will be the biggest thing. There is apartments, long life residential units. And so that is the apartments, that is your nursing homes, that's your single family long-term rental. So that's the traditional way to look at a house. Again, is that 39-year property is going to be your transient or your hotels, your rent by the week. It's going to be, I'll be honest, your detox or potentially your treatment centers that their people aren't staying there very long. Those items are going to be 39-year. And again, it's more of the thought process of if that's a hotel, it's not your house. You're just staying there for a little while. But the biggest thing for tax depreciation is short-term vacate or 39-year property, we can take qualified improvement property. So when we're renovating a bathroom or we're tearing down a wall or adding walls, those would normally be a long life asset. Well, those become a 15-year qualified improvement property life, whereas in a 27.5 year or an apartment, we cannot take that as 15 years. So a bathroom in a short-term vacation rental, we can take as qualified improvement property, take bonus depreciation. A bathroom in a apartment, we're not going to be able to do much because the IRS says a dwelling has to have a bathroom, if that makes sense.
It does. So in other words, like if you find something that really needs some like significant improvements, you're not going to get nearly as much credit in an apartment necessarily as you would a single family because you
Correct.
can you can classify those improvements, those renovations as 15-year, where you
Yep.
normally you wouldn't be able to in an apartment rental.
Yep.
Okay, that's fascinating. Um, Steve, anything else you'd add to like picking superlative properties, or anything you can think of, or Richard, anything that comes to mind for you on the tax side?
I'd say if you got this would probably help Steve and his team out. And sometimes we can piece this together as an ad hoc cost seg if it's granular enough. But if you're going to spend $100,000 on um, improvements on a property, try to get your contractor to spell out in as granular of detail as you can what they okay, I got $100,000 of cost, but what is it? What are you doing component wise? And break that out on some sort of invoice or something and go, yes, of this 100,000, this amount went into new countertops for the kitchen or whatever it might be, new cabinets. Um, a lot of times they won't do that unless you ask them, but since they're doing the work, they should be able to, in theory, tell you what their cost is comprised of. And sometimes we can use that if maybe you got a property that's not a good uh the initial purchase was not going to get you much on a cost seg, but hey, this renovation that we did is mostly property that would qualify as 15 years or less, then we can just look at that as your CPA and go, okay, well, we'll just put it into the class life that it exists in, and assuming that it went into service after January 20th, and was purchased after that point in time, then we can go ahead and use that as what I would call an ad hoc cost seg and
Yeah.
essentially just capitalize that stuff and immediately depreciate it on your tax return. But even if you are giving it to Steve's team, I would assume, Steve, that would help you guys out to have that level of
Correct.
detail.
Very much so. And so the only thing I would also kind of allude to or whatever is cost segregation's it's been the hot topic for short-term vacation rentals. But for anybody listening or anybody on here, it can be any investment property. And so anybody that owns, it can be an office building, it can be, I'll be honest, the number one reclass for items, and we still do them, just kind of to check the box, and that is car washes, potentially gas stations with 50% more to sales, oil change facilities that I have 50% more to the base to oil change in that. Those properties, you can actually write off the whole building and those takes this with bonus depreciation. Now we have passive rules, you have the material participation, qualified real estate professional, which is a different topic for another webinar. But those are great things. And so again, as business owners are doing this, and that is this is not just limited to short-term vacation rentals. A cost segregation can be any investment property.
Yeah, and to that point, if you're a self-employed, business owner that has an office in their home, it could also be extended to the home office through an accountable plan inside of an S corp or something like that. So that gets a little bit hairier, right, in terms of,
Yep.
personal use versus, strictly business use. But it could extend that far as well. There is a use case
Yep.
um, for that. I'll also throw out there, like, we've we have a client who has a pool that they put on Swimply, which Swimply is like Airbnb for renting pools from people, which unlock the potential, to depreciate the pool against that activity, which they materially, and actively participated in. So there's a lot of angles where this could apply, not just the short term, to your point. Okay, thank you guys. Appreciate that. Let's talk a little bit more about strategy, right? So, like, let's say you got the short-term rental, you meet all the criteria. Steve gets your cost seg, rolling. We know what that amount, roughly we expect to be. How can we pair that with other tax strategies, right? Well, this has been super attractive for a lot of our really high income earners because we're just going to straight up use it to offset W-2 or 1099 income. Um, you could also, potentially couple this with something like a Roth conversion, right? If we have a big deduction, right, we can accelerate income, into that year that would then be offset, right, by the depreciation that came from the short-term rental. There is a law of diminishing returns here, right? Though, like, if your income is really high and you start off at 37% and, scale down, once you get down to, 22, then 12% taxable income, you're not really getting all that much bang for your buck at that point in terms of tax savings. Um, so, in a case like that where the cost seg was so large that now your income is, 12% taxable income, we might accelerate some additional income into that year. Again, a la like Roth conversion, right? To, really get the benefit from it. But, um, pairing offsetting active income is certainly like the number one, tax strategy that we pair it with. Um, Layering with other vehicles, coordinating strategies. The clients may already use like 1031, exchanges, retirement contributions, entity structuring, right? So, this is not meant to be like a silver bullet, right? There's a lot of different things we can do on the tax planning side that can, create a lot of value for clients. I think, coordinated wins, right? So, uh, taking in the full picture here, the timing, what your goals are. I mean, this is where the magic really happens. Like, you know, I think we have an example of this, in a slide here coming up. In fact, I might just jump to it. But uh, if you were thinking about having a primary home in Florida, right, as an example, you could set it up, spin it up first as the short-term rental. We want to run that as a business, for at least 3 years. And Richard and Steve, I don't know if you guys want to speak to the time horizon over which you want to, you know, sort of operate as a business before converting into a primary residence.
So just because you convert into a primary residence, the idea here is that um, we're trying to get around, let's say you've done this cost seg, um, you're trying to get around bonus and ordinary income recapture. Now uh, there are some caveats there. So so generally on what has been, so that will work for a per se passive activity. Anything that's been actually classified as a business and has risen to that level, which goes back to something that we haven't exactly talked about, which is whether you provided substantial services or not. But if you've moved over and it's on that business level, you can't use that rule to convert it to a primary residence and then exclude the capital gains recapture. You could do that on a long-term rental property. But what you can do is maybe you just don't want to. After 3 or more years, you decide it's not your bag. So you can live in that property for at least 3 years, and you get the capital gains exclusion on any part of that that wasn't previously depreciated. So let's say that after you converted it to a primary residence, you make some additions or something like that. That would be then excluded because you made those additions after it became your primary residence, and you can exclude those from capital gains tax. So you do have to watch out if you've actually gone and you've turned this into a business by providing substantial services. And that's things like um, hotel-like activities. So I've got a staff that's on site 24 hours a day if you need them for this Airbnb. I go in daily instead of just providing linens and getting out of there and then changing the linens, after the guest checks out. You're in there every day with some sort of service, changing linens, giving them towels. Maybe you're providing guided tours, something like that. That then pushes that onto from a Schedule E to a Schedule C. And now this is considered just like any other normal business. So you're outside of now the rental real estate rules. So you do kind of have to watch that.
And so one example would be if you had a short-term rental, right, that you were planning to convert to a primary residence at some point in the future, you might take it out of short-term classification and make it a long-term rental for some period of time before converting that down the road, theoretically, right? Because I think the issue that we're coming up with here is going from a Schedule C to personal use means
Right.
you would recapture it. But if it's moving from a Schedule E to personal use, which is like a passive activity, um, and if you don't have a good answer on that, we can take it offline and debate it and discuss it later. But um,
I think that's a very interesting. I'd have to look into that. That is very interesting. If you went from, okay, yes, I did provide substantial services, but then we knocked it down to a Schedule E. Now it's per se passive. We're in these rules. Can I then use the 3 year rule? I don't know the answer to that one off the top of my head.
okay, we'll dig
So
into it.
yeah.
Yep. Um, and so I think like at the end of the day, right? Like I said this before early on in the presentation, but this isn't for everybody, right? It's going to take some work, and ideally, it's coupled with other broader goals that are part of your financial plan that are related to owning real estate, either, for enjoyment, for like another season of your life, right? Or because you like the idea of a tax-advantaged asset class with low correlation that kicks off income, right? That you can use leverage to purchase. Um, real quick, I'll throw out something I always tell people is, pumpkin patches, right? If you can find a property, at some point towards the end of summer, beginning of fall, right, you're going to have enough time to close on it, right? Get it furnished and get it listed to avoid that sort of like reverse Augusta rule, place it into service. And even if you're using property management and cleaners, right, that test of, nobody did more work than me because it's such a short window of time in the year. You have a higher likelihood of attaining the right type of classification to really leverage it. Um, okay, so I'll move on from there. Just based on time to get into the model here. So, ownership and management, right? You have to have real operating responsibility, especially if you start off, very, very early in the year, or you bought it the prior year and you're trying to go for short-term rental treatment, in the following year, right? Like you have to be very cognizant of these tests. And if you're going to use a property manager, um, this, be prepared for pushback from your CPA if there's a full 12-month cycle and you're not in there, again, offering substantial services. Um, and so you want to be cognizant of how you set this up and again, the timing in the year. And then like at the end of the day, it's an investment, right? So like point blank period, like is it a good investment? How does it pencil out? And so with the remainder of our time here, I want to pass it over to Matt to kind of talk about what we look at when we're underwriting a property investment and some of the key metrics and components and tools for research and due diligence that we sort of look at.
Thanks, Sam. Yeah, the at the end of the day, like Sam said, we're many folks are underwriting and looking at the acquisition of short-term rental properties as an economic investment, in addition maybe to a future second or primary home. And it's important to be able to evaluate that economic investment compared to other short-term rental property acquisition opportunities, in addition to comparing it to what you might be able to get investing it the same capital you put towards the short-term rental acquisition to maybe investing in the stock market or bonds or any other asset class you can invest in. So there's plenty of data out there. We've developed a what we call a back of the envelope evaluation tool or a model using publicly available data sources and some common knowledge paired with the tax benefits that Steve shares with us. And we're going to take you into that. So before we move on the right side of the slide here are just some resources that help inform the economic evaluation of how a property might perform, how much income you might be able to get, how much it might cost to operate that property. We rely pretty heavily on AirDNA. There are these other resources, Rabu, Price Labs, and Mashvisor, which can be useful too. But I want to stress the importance of taking everything these resources provides you with a grain of salt because it's using basically AI technology to come up with market data and each property is individually unique. So it's important to look at the data those resources provide and put your own eyes on them and your thinking cap on them. Next slide, please, Slam.
You got it.
And so the back of the envelope model is really just two pictures. One is your capital picture and one is your operating picture. How much is it going to cost to buy the property and how are you going to pay for the property? And then how much revenue are you going to get for that property? How much is it going to cost to operate that property? How much is left over after to pay your mortgage? And then what your returns to equity are when taking into account depreciation. Next slide, please. So this is the summary of what Steve sends over when he provides a cost segregation study estimate after he's evaluated all the different components of the building that you might be thinking about purchasing. He sends over a estimate. And so In this particular sample short-term rental property we looked at, the improvement value, the building value is 62% of the total, and the land was 38% of the total. Like Steve said earlier, you can't depreciate land, you can only depreciate the building. And so Steve estimated that $365,000 of building value might allow a first year tax deduction of between $87,000 and $116,000. Now we know Steve is usually pretty conservative in these, and also that he's not factoring in furniture, fixtures, and equipment into this estimate. So we took the high end of the range that he provided, $116,000 of first year accelerated depreciation. And on the right here in the table, try to figure out how much of a tax deduction the purchaser might get. Well, we know the purchaser is in the 24% tax bracket for federal, 6% tax bracket for state. And so we know $116,000 of tax deduction means about $35,000 in cash benefit to this purchaser in that first year. We know Steve's going to charge between $4,000 and $5,000 for his study. So the net benefit is just over $30,000 from doing this cost segregation study in the first year. Next slide, please.
Got it.
Okay, so this is the capital summary and the return summary of what we call our back of the envelope model. Again, this is a sample property based on one that a client was looking at. The client's looking at a property that has a purchase price of $589,000. We factor in the cash savings from Steve's cost segregation study, add some closing costs, add some costs like furniture, fixtures, and equipment, maybe some fixing up here and there. And we get a total cost to buy the property of about $600,000. We are assuming that the purchaser is going to put 20% down. So that means that the mortgage will be 80% loan to value, LTV, of the purchase price, which ends up with a mortgage of about $470,000. And the purchaser is going to need to put up $129,000 to make up the difference between the mortgage and the total capital uses to buy the property. Now, in the bottom left-hand quadrant of this slide, we have our returns and operating summary. And so when we look at returns, we're looking for how much cash should I expect to get every year out of this property? What's that as a percentage of the total equity I put down? Debt service coverage ratio, which is the amount of net operating income the property should provide, divided by the total mortgage debt service. And what that really tells us is how much space do we have for the net operating income to fall short before we can no longer service our mortgage from the operations of the property, and we might have to come out of pocket for it. And then the 7-year IRR is a internal rate of return calculation, which takes into account the cash outflow of $128,000 to purchase property, the annual cash flows of net operating income to equity, and we're assuming a sale of the property in year 7 after the property is appreciated and the mortgage has been paid down a little bit. And so those are the 3 return metrics we look for. We usually look for cash on cash returns in the 4.5 to 6.5% range in year 1. Debt service coverage ratio of about 1.15 times to 1.25 times. Annual debt service. We like to see IRRs like 15 to 20%. Right. Is a great number to look for.
Because that's essentially what you're comparing any alternative to, right? That IRR is the last one where it's like, hey, over the 7-year window, if you had bought stocks, bonds, et cetera, any other investment, would this have had a competitive, return over that window, using some conservative assumptions?
That's exactly right.
Awesome. Thank you, Matt. Let's jump into the next slide. Okay, here you go.
Sure. So this is a screen grab from one of those publicly available data sets online that we look at, and this is called AirDNA. AirDNA, type in an address and it will spit out, based on market data that it has access to, a projected revenue assumption, percentage of days it'll be occupied average daily rate, and the expected operating expenses. These ones that we've highlighted, projected revenue and operating expenses, are really the two metrics that spits out that we're most concerned about. Now, being a savvy real estate investor that you are, you want to look for areas that maybe AirDNA or the rest of the public hasn't picked up on. Is there a way to drive revenue higher than AirDNA assumes it can be? Is there a way to reduce operating expenses from where AirDNA thinks it should be? These are how you're going to achieve outsized returns by having higher revenue and lower expenses. It seems obvious, but it's pretty important. And again, I'll encourage you, AirDNA in particular sometimes tends to underestimate operating expenses. So when you're on that website, I'd encourage you to just click on the number and it'll give you a breakdown of how they summed to that $54.1 thousand dollars per year in annual operating revenue. And you want to make sure you're looking at the annual operating costs on a line by line basis. So if you're paying a third party management fee, usually that looks like somewhere between 15 and 30% as a percentage of revenue. But we want to make sure everything else is in here is accounted for too. Is the property part of an HOA where you'll owe an HOA fee? How are utilities getting paid? Who's responsible for those utilities? If it's you as the owner, you want to make sure you're estimating those utility payments in your operating expense estimates. How much are you going to need to pay cleaners to clean up after guests? How much is annual maintenance expected to be? Sam and I usually use a rule of thumb of about 1% of the value of the property. And how much is property insurance going to be? How much is property taxes going to be? That varies from jurisdiction to jurisdiction. And it's important to do good research on those items and make sure you've got good assumptions in your numbers before concluding that the property will be an economic success. So here's the other page of that back of the envelope model, the operating projection. And you'll notice at the top there are two numbers that are highlighted, your total revenue and your total operating expenses. And those are taken from the AirDNA data that we were looking at on the previous slide. And so again, your total revenue minus your operating expenses will equal your net operating income. That's how much money is left after paying all the expenses associated with your property that you'll need to then use to pay your debt service on your mortgage. The cool thing about revenue and expenses and net operating income and mortgages, if you do it right, is that your net operating income should grow over time. And often you will have borrowed a fixed payment mortgage. And so your debt service is staying the same while your net operating income is growing from year to year. So you've got more space in your debt service coverage to your debt service coverage gets bigger over time, and your cash flow return to equity also gets bigger in nominal dollars and as a percentage of initial equity put in over time. And so where Sam's pointing at the bottom there is showing your equity cash flows. In order to buy the property, you needed to outlay $129,000 of equity capital. And then in year one, your cash flow to equity is about $5,700, growing to about $9,600 in year six. And in year seven, we're assuming a sale. And so your $589,000 purchase has grown. We're assuming at a pretty stable 3% per year to $724,000. You got to pay some agents to effectuate the sale, and you pay their fee is about 3%, total 6%. And your mortgage has gone down over time by making your debt service payments. And so sale proceeds would be expected from this property about $258,000. And so that gets you your 7 years of cash flows and an internal rate of return, again, that takes into account the timing of cash flows and the time value of money of about 15%, and an equity multiple of about 2.44%. So that's all the cash you took in divided by the cash that you put out. Is another way to look at returns. But really, we're looking at that IRR. when we're comparing it to other properties and comparing it to other investments in different asset classes.
Yeah, your capital could go anywhere in the world, right? And so, if it's going to go into the short-term rental, even if you're going to get, some significant tax planning opportunities as a result, it still needs to pencil out, right? It still needs to be a good use of capital at the end of the day. So, I think with that, I'll just kind of wrap up here. Like we talked about, the three pillars, right? The tax component. So long as we meet the criteria, 100 hours, average say 7 days or less, nobody did more work than you. The cash flow component, servicing the debt, right? And then, of course, potential appreciation and 30-year fixed rate mortgage is a marvel of wealth building. It's just a really incredible sort of tool to use in your planning to be able to borrow at a fixed rate for 30 years and sometimes 5x your original capital with a 20% down payment. I mean, this is the reason why leverage is so attractive and why this math in many cases makes sense. But in terms of risk management, right, documentation is key here. Like you can't be flippant about documenting your hours or not doing it contemporaneously. Like you're your best defense to make sure that if you were ever audited, that everything would come back hunky dory. Of course, there's regulatory risk and market risk with changes to local zoning or NIMBYs or that kind of thing. So you need to be cognizant there and like to thine own self be true. Like, do you have the bandwidth to take something like this on at this point? Are you really ready to to implement a plan like this with the hours that you have in the day? And so if you are interested, in learning more, we are happy to help. That's what we're here for. We would love to sit down and crunch the numbers and, see if a plan like this makes sense, through the broader lens of your financial planning and your goals. So with that, I'll take this opportunity. Thank you, Richard, Steve, and Matt. You guys were awesome. Really great work. I think this was super impactful. And I'll thank all of our clients for their business and more importantly, for their trust.